afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. So we have seen in the last 2 weeks, two distinct sets of data. We've seen warmer economic activity, but at the same time, we've seen warmer inflation data. So we're going to pause for cause on this call with David Burrows, our Chief Investment Strategist and President here at Barometer, and we're going to dissect that at those 2 points of data and figure out where Barometer is leaning and what we're going to take away from those data points. So with no further ado, I'm going to warmly turn the conversation over to Dave Burrows. If you do have questions at the tail end of the call, we'd be pleased to address them. You can hit me up at phastings@barometercapital.ca, or feel free to send us a question via the Q&A or the chat via Zoom. And with that, I turn the conversation on this last day of February to David Burrows. Good afternoon, David.
Hey, Pam, how are you?
Great, thank you. Looking forward to this conversation.
Great. Well, thanks everybody for joining. We got lots to talk about today. And as Pam mentioned, we've had a lot of data for the market to digest as we've come into the end of February. Just to recap, the year started smartly with a very strong breadth thrust at the beginning of January. We rallied through the end of January, lots of strength across the board. The beginning of February also started strong, but the market has had a lot to digest over the last 2 weeks, and February has wound up down a couple of percent for the S&P. We want to take away what we can from the way the market has reacted to the news, sort of less so what the news is itself, because in the end, the market is this great synthesizer, takes information in, and price behavior comes out. And we like to do these webcasts every week. It causes us to re-examine our thesis, re-examine our positioning, make sure that we continue to be in tune with what's going on. So without sort of further ado, maybe we can just start that process. From a big picture perspective, and we do this because 70% of return in a portfolio comes as a direct result of the impact of the asset classes we're focused in. And then within those asset classes, the sectors or themes that are driving returns. 70% get to the right neighborhoods. 30% is find securities that you can use to express your view. And so single stock or single security selection adds a lot of value. But we like to marry the top down with the bottom up and come up with our portfolio. So our premise has been since 2013, we were in a structural bull market in stocks for equities. We've had a series of rallies followed by corrections and or short-term bear markets. But we have maintained above this 200-week moving average, which is common for the market to hold when we go through a long-term structural bull market, much like we did through the 80s and 90s. A structural bear market, the thing we really want to avoid is a period where the asset class goes right out of favor. You wind up chopping back and forth for a period of years, in this case, 13 years, where the market made no progress. And in that kind of environment, you really have to pick your spots. You have to be much more tactical, and you can make money, but you really got to be on your toes. This type of market is a little easier. But having said that, we still see big bad bear markets, and certainly the period between January of 2022 and the present has not been easy for anybody across any asset class. But we maintain above this 200-week moving average, which for us means we continue to be in a structural bull market. And interestingly, so far over the course of the last number of months, actually, global stocks are actually doing a little better than U.S. stocks. U.S. stocks started the structural bull market in 2013. When we look at yields, we continue to believe that we ended a structural disinflationary period that went on from 1981 to 2020, when we saw a generational low in rates, and we started a new period of rising rates, much like we did in the early 1950s. So that means that what works going forward likely is very different than what worked over the last 40 years, which is difficult for investors because we all build a body of experience that we use to make our decisions. And those experiences may not be much help as we go forward. So we like to study history. We know that history doesn't repeat itself, but it does rhyme a lot. We like to understand the things that can happen because, for instance, there is a broad belief that when interest rates go up, stocks can't go up. But I can assure you that from 1951 to 1966, the US stock market went up 15% a year. 15% a year against rising rates. Now, it wasn't necessarily high multiple stocks. Dividend growth did really well. Some more cyclical sectors did well. But we'll talk about that as we go along. When we look at commodities, sorry, this is long-term interest rates. They peaked in 1981. They fell to the lows at 40 basis points in the US in 2020. At that point, we had trillions and trillions of dollars of negative yielding debt around the world. Since then, we've seen an abrupt reversal in yields. The Fed is out of the business of QE, as are all central banks except for Japan. And the yields got to a high level of about 4.4%. They consolidated over a period of months and then resumed their upward trajectory, as we talked about last week. So this is the TLT, which is the 20-plus year Treasury bond ETF. So US Treasury bonds. The price peaked in March of 2020 at the pandemic low, and since then has put in a series of lower highs and lower lows. And to me, if we're now 2 years in, we are in a bear market in bonds. Last year, the TLH, which is the 20-year US Treasury, was down just around 20%. The TLT from the top down 48%. Not a friendly place to be, even for a conservative investor who wasn't probably considering that bond prices could fall the way that they have. So my guess is, as time goes by, probably fewer and fewer people will be interested in owning bonds, even though so far this year, there's been a surge in buying, people being excited about the fact that yields are a little higher. Keep in mind that in the last structural bear market in yields, 1951 to 1966, bonds gave a 1.6% rate of return annually, and inflation was 1.6%. There was a 0% real rate of return over the entire period. So having said that, people go to what works or what's worked in the past. And when the bonds went down in price and yields went higher, they went and bought bonds. And that's what they've done so far this year. Probably not the best thing, in my opinion, but the crowd tends to always be looking backwards. On the other hand, stocks are doing some repairing, but a lot of money coming out of stocks. So we want to keep that in mind as well. Commodities. Commodities were in a broad bear market. This is the DBC, which is a basket of global commodities. Fell in price from 2008 through 2020, a disinflationary period. And then we entered a reflationary period. Yields going higher, commodity prices going higher, inflation prices going higher, commodities universally unloved and would expect to be collapsing if we think there's some kind of a hard landing recession, actually rallied until June while the stock market started selling off last January. So rallied 6 months longer than the stock market, wound up broadly positive on the year last year, and up against it all consolidating over the last few months. If we compare and contrast the DBC, which is the broad-based commodities index, versus the TLH, the US long Treasury ETF, you can see it has been outperforming bonds steadily since 2020 and continues to be the case. Gold relative to the QQQ. So gold, long bear market, reversed that trend in 2022 and has been consolidating over the last couple of months versus tech. But my guess is that that's an important regime change. So this is probably the most important chart in the world of macro today. And it's one I'm going to refer to a couple of times today. This is the US dollar index. So one of the characteristics of the US dollar is that it's seen as a safe haven asset, a place where people go when they don't know what else to do. So you can imagine that when the bear market started in the stocks, people started buying US dollars. This is the US dollar versus the euro, the yen, and the Great British and the British pound, largely. So the DXY rallied from the early part of 2022 through until just around the time the stock market made its low for the year last year, or the S&P anyway, in October. Actually, this topped in the end of September. It started to fall. And over the period of the next few weeks, put in a rounded top and broke long-term trend. It pulled back, ultimately broke the support level in here at a little over 105, retested it from underneath, fell to a lower low, and is retesting it again. So interesting. The stock market bounced from October through until the beginning of February. And then the US dollar bounced and the stock market's pulled back a little bit. And some commodity prices pulled back a little. This is an important battleground for the US dollar, something that we're watching. And we're watching for signs underneath the surface for where it may resolve. And we'll talk about that. But first of all, just want to make sure that we're clear. We are not going to be everywhere. Barometer has a view. We have to pick our spots. From a top-down perspective, we want to find parts of our broad investing universe that are seeing net new inflows of capital today. That could be specific asset classes like equities or commodities. It could be specific industry groups or themes or sets of securities like value versus growth. But we have some tests to identify where money is flowing to, and we measured that using breadth, the percent of securities in those groups that are performing well. In a healthy environment, the breadth within a universe of securities performing well should be expanding. More and more stocks should participate. We use a bottom-up process to try to identify specific securities that relative to their peers are good, getting better, are seeing improvement relative to their peers in their price action. Are they behaving better from a price perspective? And are their fundamental characteristics getting better? Revenues, profits, cash flows, some income statement and balance sheet measures. So we measure 60,000 securities to identify a group of securities that meet our basic tests, which are companies going through a positive change, where they line up with groups that we care about in the market. We'll talk about those today. Well, that's where our portfolio lives. Now, it's a living, breathing thing. We recognize markets change. We recognize securities come into and go out of favor. So the last important piece of the process is how we manage that inventory in client portfolios, and that's a disciplined selling process. Because I would argue the bigger mistakes that investors make aren't so much about what they buy, but more importantly, what they don't sell. And so having a disciplined selling process is really, really important. We use stop losses on all of our positions. When we enter a position at, say, $20, we identify a price below the price we've paid, where if we drop below that level, there's evidence situation is changing. We've used up our risk budget. We're going to go to the sidelines. We would rather have a bunch of small losses than big losses. So if we buy 20 securities, 2 or 3 are going to work out way better than we thought. They just continue to get better. 7 or 8 are going to be pretty good, and a bunch don't work. And as long as we make sure that the ones that don't work don't hurt us too badly, we're ultimately going to come out okay. So we use the stop losses. From a top-down perspective, as I mentioned, we are looking for breadth, improving breadth. So when you go through lows in a group, say an industry like energy or housing or consumer staples, the strongest companies will invariably turn up first. And as the things get better for that universe of securities, the buying will start to spread into more and more securities. In a healthy market over time, more and more securities should participate in a rally that's healthy. There's no bear markets ever took place when that was happening. Late in advance, at some point, something starts to go wrong, some problem starts to show itself. People decide to take some exposure off. They don't sell their favorite positions first. They sell the ones they got nagging doubts about. So the weaklings sell off first. Underneath the surface, generally not impacting the strongest companies or the biggest companies in the group. But eventually, if enough securities roll over, it'll impact the better companies, and one by one, they go the other way. This is what we want to avoid. When we see deteriorating breadth, and we measure this across 300 different universes, it means we stop putting on new positions, we tighten up our stops, and we stop putting on any new positions. And we use this to help us rotate to the parts of the market that are seeing new net dollars getting put to work. So this webcast is something that we do to test our theories and look at where things are going. Now, at the beginning of the year, we saw breadth across all major measures, markets, sectors, and themes performing well. January was excellent. But in the last few weeks, we've seen some deterioration in breadth in US stocks. Canadian stocks, breadth seems fine. Global stocks, breadth is actually improving. But underneath the surface, somewhere there is some weakness taking place in US stocks. It's not in all sectors. So we're going to dissect that a little bit. The percent of stocks trading above their 50-day moving average has come down from 70% to 50%. That means some stocks are behaving worse than others. It means we got to be a little bit more careful about not putting any new positions on. Percent of stocks with positive momentum has waned some. Percent of stocks making new highs versus new lows, getting a little bit weaker. And the percent of stocks trading above their 150-day moving average, while has been very steady, has moved down slightly. So we take that into account. The broader market is correcting. Now it makes sense. Market had a great rally from October through the end of January. In many cases, stocks became well extended above their 200-day moving averages. So it makes some sense that we might pull back a bit. The second 2 weeks of February are typically weaker. We tend to see corrections there. In the NY and the TSX, breadth has been improving since September, where only 24% of stocks were in uptrends, and steadily since then, the percent of stocks in uptrends has been rising. We got as high as 50% at the beginning of February. When we look at the bullish percent, or the percent of stocks in uptrends in the NYSE in October, only 18% of stocks were in uptrends. We rallied through October, November, pulled back in December to a higher low. When the market pulled back, 40% of companies maintained their long-term upward price trend, as opposed to only 18% in October. We rallied then to 66% of stocks in uptrends, and since then pulled back to 56. So 10% of the companies in the NYSE have broken their trends. It means some stocks, if we owned them, would have to be stopped out. It means we probably don't want to put on new positions while this continues. And we wait and we watch. We aren't going to go sell everything. Our job is to make sure that we're carving out the stuff that doesn't work. So if I take the NYSE composite, as I said, 18% in uptrends in October, we made a higher low in December. We've made a higher low recently. You can see the 200-day moving average, which had been declining. That's a long-term measure of trend. Actually, over the last few weeks has been flattening out and turning higher. The 50-day has been moving higher, but we've broken below there. So we're watching that. If you look at the S&P 500, same thing, 200-day moving average and moving lower. We were in a bear market. We made a low in October of 10% of stocks in uptrends, 42% of stocks in uptrends in December, 55% of stocks in uptrends today. We are, though, holding above the 50-day moving average in the S&P. We're above the 200-day. We've corrected back towards it. That's perfectly normal. That's the way markets go through bottoming processes. This is a process. There is a mishmash of data. In the last few weeks, we've had a real cross current. For those that think there is a hard landing recession coming, it's been tough on them. Retail sales came in well ahead of expectation. New home sales came well ahead of expectations. Consumer spending came in hot, and the GDP data, not so bad. On the other hand, the inflation data that everyone's hoping is going to come down has come in a little warmer. Producer price index came in warmer than expected. CPI data didn't surprise for the better. It came in as expected, but I think people hoped it would be a little bit better. So on one hand, you've got people concerned about inflation, which means maybe the Fed continues to raise. On the other hand, the economic data is not weakening like people expect. Employment data, for instance, maintains a very solid bid. So stocks are testing, and we're testing through this data. So far, we're holding above the 50-day moving average of this long-term trend that we broke. We're retesting it. That will be typical. We're above a 200-day moving average. This is tipping higher. This next little bit will be important. Now, we talked last week about the fact that early in the year, last year's biggest losers have had the biggest gains. And we questioned that. It's unusual to see stocks that are down 70 or 80% just turn around and go the other way for an extended period. So we really have been concerned that there's a lot of money chasing last cycle's leaders, and that ultimately the short covering could roll over, and we'll see the real leadership emerge. So we know there was a ton of short covering in the early part of the year. And we raised this, that when you look at the QQQ, which is all growth stocks, most of them high multiple, every time it had a counter trend rally over the last year, it tended to run out of gas. And we questioned whether the bounce that we had earlier in the year would continue. When we looked at what happened to the energy stocks when they went through their bear market from 2014 on, Every time they made a 3-month relative high, the next month, 2 months, and 3 months was underwhelming. So our concern was we could see some weakness in tech. We highlighted that in January of 2021, tech had a big bounce, despite the fact that it had 2 years of a bear market still in front of it. And this year we had a big bounce. Okay, so since then, in the last 2 weeks, we went from 76% of companies in uptrends. First of all, market made a low in October. The QQQ actually made a lower low in December, very different than the S&P or the NYSE. So that's a clue this is not the strongest group. There was obviously tax loss selling going on. When tax loss selling was over, we got a bounce. We extended above the 200-day moving average, and since then pulled back about 7%. Percent of stocks in uptrends went from 76% to only 40. In other words, 36% of stocks gave sell signals over the last 2 weeks. A lot of the indicators are weakening. We highlighted last week that the group work pointed to the fact that the tech sectors had all reversed down in breadth and that we wanted to be cautious there. Well, since then, bullish percent went from 74% all the way down to 40%. That means this is not a group we're adding new positions in. It means we are being very critical of the ones that we have. We had put on a small position in Google. We almost immediately came back out. Concerns around ChatGPT and Bing weighing on the stock, and concerns around their revenues that they get from their search engine if they were to be cannibalized on the ChatGPT. So let's talk about leadership sector to sector. First of all, financials have been leading. They're our largest weight. What's going on? Well, we know that 26% of stocks were in uptrends in December, when the market in the NASDAQ made a lower low, actually held a significantly higher low, 50% of stocks in uptrends. If we look at the banks, 62% of stocks in uptrends today, we're trading above a rising 50-day moving average. We have a rising 200-day moving average. We've maintained a lot of strength despite the fact that the market's been backing off. On a relative basis, this group continues to outperform. If we look at some of the names we have, we're very pleased that the leaders are outperforming the group. In our top 10, JP Morgan comes in at number 3 of our biggest weights in the firm. We used this yesterday as a top pick on BNN, trading at 11 times earnings. It's got a nice dividend. It grew the dividend 13% a year over the last 5 years. It's a dividend growth stock. Banks tend to do well when rates are rising, and certainly rates have been rising. We will see if the bank relative performance follows the typical correlation and works its way higher, but certainly JP Morgan is trading within a whisper of a 52-week high. If we look to the insurance stocks, this has been the strongest group in the financial services sector. 14% in uptrends in October, much better breadth by December, 45% of stocks in uptrends, 60% of stocks in uptrends today, and breadth is rising. The 50-day moving average is moving higher, we're above it. The 200-day moving average is moving higher, which means we're in an uptrend, and we're trading again within a whisper of highs, about $1 off the high for this ETF. But now let's look at our biggest positions. Industrial Alliance Group, again, in the top 10 positions in the firm. 3% dividend. Dividend growth rate over the last 4 years, 11% a year, trading at a new 52-week high today. Now, I will say, with the stock trading at $91, 90% of companies that trade through 90 trade through 100. That's a rule that I've learned over time. This is a significant outperformer, making a relative strength new high versus the S&P 500. And Fairfax Financial, another Canadian property and casualty company with lots of private company investments, again, making a new 52-week relative strength high, trading at $949, closed at a new all-time high today. So insurance certainly continuing to act well. We also own Progressive, which we've talked about over the last few weeks. So let's move on from financials. Financials, check. Industrials, second biggest group of holdings that we have now at the firm. The similarity between industrials and financials, both are sectors that do well during reflation. Both sectors that are highly economically sensitive. Both sectors you should expect would be getting hurt if we are headed for a hard landing. Market is telling us something different. 16% of stocks in uptrends in October, 38% in December. Today's 68% in uptrends, continuing to improve, trading above a 50-day moving average. trading above a rising 200-day moving average. Relative performance versus the S&P is rising, and lots of things to do here. Now, we've talked about defense stocks, but let's talk about some industrial machinery companies that we own. Bombardier, a company that's had a mixed pass, has been having a great run. We're trading within a whisper of a 52-week high, trading better than 97% of all the companies in the S&P over the last 12 months. Estimate for 2023 is for earnings to be up 194%. Earnings are expected to be up 89% for 2024. And of course, this company now really focused on global executive jets, Global Express, Challenger, and Learjet aircraft. The other group we talked about yesterday on BNN is ATS Automation. This is a tooling company that does automation systems for food and beverage, for transportation. Recently, rumored to have a very large EV contract for Ford Motor Company, for GM, but this could translate into other companies. We've seen relative strength versus the market rising since way before the market made a low. This stock bottomed in May. The market bottomed in June and then a lower low in October. Continues to work its way higher again, very close to a 52-week high. This is how leading companies and leading groups should act. Let's move on. This is the FXR ETF. It's just durable goods. And durable goods, X defense and X aircraft came in well ahead of expectation this week, and stocks continue to respond. Again, this ETF today made a relative strength new high. There's 6,000 ETFs that I track. Only about 15 of them made relative strength new highs, so this group continues to act well. Aerospace and defense, we won't talk about this today, but made a new 52-week high only about 10 days ago, pulling back a little bit, rising 50-day, rising 200-day, made a series of higher lows. Nothing to worry about here. Let's move on from industrials to materials. We talked a lot about materials over the last couple of years. Our belief is that we saw a structural low in commodity prices in 2020. This is a very contentious group. These are companies that produce steel, produce cement, produce metals, produce chemicals, highly economically sensitive companies. Now, there is a theme that's taking place, and that is that we expect a lot of reshoring of manufacturing to North America. We've had significant disruption to the global supply chains, as many of these basic materials come from China or come from Eastern Bloc countries like Russia. And so we're having to rejig things. It means these companies have pricing power. There's a shortage of metals because of the surge in EV manufacturing. And we need more copper and we need more nickel. So yes, we are concerned about the economy, but it may well be that the structural demand is offsetting the supply because it takes a long time to put new supply into being. But if you think that there's a hard landing, you should expect these to be behaving very poorly. Yet we made a low in October at $50. We made a much higher low in December at $60. We rallied as high as 72 on the FXZ ETF. We pulled back to 66 while the US dollar was strengthening. But look, the US dollar pulled back marginally for 2 days. And we jumped from 66 to $69, right? That's a big percentage point move for a very small move in the dollar. If we look at it another way, let's compare the way that the materials ETF is trading relative to the NASDAQ last cycle's leaders. From the time the NASDAQ rolled over, the FXZ outperformed all the way through until June, 6 months into the bear market. So it held on way longer. Leaders should hold on longer through a decline before people decide to become sellers. Now, of course, there was a crescendo of selling in June and July where it pulled back on a relative basis. But look, it bottomed in September. The market bottomed October the 6th. And by then, already, FXZ was rallying relative to tech. It rallied all the way through the dollar's pullback into the early part of January. And when the dollar bounced, it pulled back. But look, dollar has been rallying over the last 2 weeks, but FXZ has been actually gaining ground versus the NASDAQ. This is a short duration asset versus a long duration asset. Long duration does well when rates are falling. Short duration does well when rates are rising. The market's message here is that rates are likely to continue to work their way higher. We need to own things that do well in a reflationary environment. And as unpopular as it is, our job is to find our way to parts of the market that are relatively outperforming at the beginning of their long cycles, not at the end, and certainly not looking backwards. I think materials continue to fit this bill. They may have pulled back through the late part of January and February, but on a relative basis, technology is pulling back and materials are rallying the other way. So 3 reflationary groups leading the market: financials, industrials, and materials. In the materials, big positions in our top 10 include Teck Resources, which in the past 2 weeks announced a couple of things. First of all, that they're likely to spin off their coal assets to become a more pure play copper company. That's good. We got a global shortage of copper. And second, that over the next short period of time, next few years, they're going to resolve the difference between the voting and non-voting shares, which ultimately is good corporate governance and makes it a more fair share structure for investors. A lot of US investors will not buy a company that has subordinated voting shares. Another very interesting smaller cap security we own is a company called 4N Mining, which is in the very early stages, but it's very, very interesting copper project in Manitoba. And you can see after a long consolidation going back over almost 2 years, it's breaking out to the upside, making new highs at the $3 stock. It is an aggressive company, but we do own a position and think it looks very interesting. We're in the kind of market where mid and smaller cap securities are behaving better, and we do have some exposure. Okay, let's move beyond materials, financials, and industrials. We talked about last week how infrastructure development has been doing well in our global macro portfolio. This ETF is probably the best performing ETF in the US. PAVE is made up of companies that supply services into infrastructure development. In our equity portfolios, one of our bigger positions is Stantec, which had a spectacular week after reporting better than expected earnings, broke out of this very large consolidation going back to the late part of 2021 and closing today at a new 52-week high. Energy's been tougher. The long-term picture for energy looks interesting. Went through a bear market from 2014 to 2020. Last year, in a bear market, was the best performing sector in the market. Since then has been correcting along the 200-day moving average. We've made a series of higher lows. We're still in an uptrend. We're testing that right now. We made a 3-month relative low. So through that process, we did pare back our holdings, more specifically in the natural gas area, which has been weaker than oil. Energy service has been outperforming, so we have a little bit more exposure there. But we'll continue to watch. But our individual positions continue to act well. We've talked about CNQ, we've talked about Suncor, we've talked about Hess, we've talked about ExxonMobil, but MEG Energy is one which is quite interesting. And the possible extra interest here is that it's not impossible that this could be an interesting purchase for one of the large long-lived asset energy companies as they carry a lot of tax losses forward. Let's talk themes for a minute. Dividend growth is one that we said should do well in a rising rate environment. We have rising relative price performance versus the S&P since July, so it is outperforming. Doesn't mean it doesn't have pullbacks, but September made a low, a much higher low in December, and a higher low in February, so continuing to get better. We're going to move quickly here, but dividend growth continues to be a focus in our income portfolio. This is the broad list of our holdings. Average dividend growth over the past years is a little over 16%. Certainly they're fitting the bill. We think we got some good positions on in groups that are under-owned. Things that are not working. Consumer staples, XLP continues to weaken. This is one we've talked about over the last few weeks. Relative underperformer, trading below the 50-day and 200-day moving average. Utilities, a long duration asset, high dividend, but very little growth. VPU is the basket of US utilities. It's trading lower, and REITs trading relatively lower as well. Other themes that are not working. Growth in general continues to see weakening relative strength, not interesting there. And mega cap securities versus small cap started out underperforming in the early part of 2022, not seeing any change there. So there's have and have nots. Long duration assets clearly are not working. Bonds, utilities, staples, not interesting. Those are things that do well during falling rates. They're defensive and should do well if we're going into a recession, but they're not. Large cap securities, which have been the darling, are underperforming mid and small cap securities, not attractive to investors looking backwards. Looking forwards, companies see value, country investors see values here. Let's just wrap it all up. This is relative performance since the bottom in October. The aggregate bond index and the TLT come in about the worst. The NASDAQ next, it's up 5% off the market lows. The S&P is up 7% off the market lows. So that's good. We want to keep focus in the most attractive areas. RDVY, the dividend growth ETF, up about 12%, XLE up 13%, XLI, which is the industrials ETF, up 17%, defense up with just over 20%, and European stocks actually up 35%. Who knew? But we have talked about global stocks outperforming S&P. When I look at relative strength new highs from today, things that are hitting the highest level versus the market in the last 52 weeks, it is dominated by mid and small cap securities, durable goods, Europe, dividend growth. This is small cap dividend growth, S&P mid cap, and industrials. So these are the groups that are working. Our job is to make sure we are in the groups that people care about. So when we look at our sector weights, you know, this is something that we do every week just to test our portfolio management versus what we're seeing. Financials come in at 26% versus 11% for the S&P. Industrials at 18%, over double the S&P weight at 7.8. We have about a 12% weight in short-term government bonds. That's effectively cash. And that's really across portfolios, about 10% cash. We are seeing some weakness in some of our indicators. Materials comes in just about 3 times the S&P weight. Energy comes in a little over 1.5 times the S&P weight. The groups that we are underweight, very small weight in technology. The weights here are in Cisco and NVIDIA, both performing, you know, really well. We also own some Avago, which is the old Broadcom, again, performing quite well, but it's a very small weight relative to the S&P. The groups that we are avoiding: consumer discretionary, communication services, healthcare, staples, real estate, utilities. So this is a very concentrated portfolio. Outside of the US, Europe continues to outperform, trading above the 50 and 200-day moving averages. Mexico is performing very well, very close to new all-time highs. Japan, currency hedged, making new highs. And EFI, which is Europe, Asia, and the Far East. Sorry, Europe, Africa, and the Far East, again, outperforming the S&P. Oh, this is mislabeled. This is a long-term picture of gold. This is a very contentious issue. My belief is that in a reflationary environment, gold ultimately should outperform, but it certainly is making us wait. We do have a weight in our global macro portfolio. It's not hurting us. It's not going down. It just doesn't seem to be making progress at this point. At some point, I would expect to see it break out of this consolidation. These are monthly bars. So we're up on the year, barely, but ultimately, and we've been moving higher since October, but we'd like to see it trade above these levels, above $2,000 an ounce. Probably makes it quite interesting. In our macro portfolio, we have industrials, precious metals, energy, financials, materials, dividend growth stocks, mid-cap stocks, some consumer discretionary, about a 5% weight, that's housing. Europe, Canada, China, developed markets ETF, that's Europe. Japan, we have a small position in Ethereum, which seems to be developing. On the short side, largely fixed income, consumer staples, utilities, and US dollars. So just to wrap up, in the beginning of January, we had a 10-day period where we had a very significant thrust in upward breadth. So significant, it's only happened 7 times since 1957. When we look forward, 42 days out, it was one period we were down 4.8%. That was 1974. As I mentioned, February was down just a little over 2%. That is well within these bounds. When we look forward, very, very high percent of cases, 100%, were positive 3 months, 6 months, 9 months, and 12 months out. In fact, an average of 26% positive, 252 days out. The securities that we're holding are working. The sectors that we're focused on are outperforming the S&P. And the holdings that we have outside of the US are outperform the S&P as well. Positioning continues to be very cautious. Lots of people are concerned. Margin has come way down. And interesting, the proportion of companies talking about recession in their quarterly conference calls has been falling off, while people are pointing to the fact that we're likely to have one by the end of the year. So we think we continue to be in a long-term bull market. We think we're positioned in the groups that continue to perform well. It's hard to go through bear markets. It really is. But it's great to be there invested on the other side when you get the run that comes next. So if things continue to weaken or our groups start to lose a footing, we will reduce our holdings. But as it looks right now, the thesis continues to work and we'll continue to move forward. So with that, I can answer questions. Pam, I apologize. I went a little bit long today.
No, that's great, David. Everyone appreciates that. And of course, I think because you extended the conversation today, you have really addressed everyone's questions. We have no questions this afternoon. So I'm not seeing anything pop up. So I guess I'll leave you with the final word until next week.
Great. Well, we really appreciate people joining us. I do encourage you to follow in between webcasts. We're pretty active on Twitter, and I'll just throw the Twitter feed up. It's at Barometer CA. We post 4 or 5 things a day. So in between things that we think are standing out, it's pretty easy to search up. At Barometer CA is the handle. And had a great opportunity to be on BNN yesterday for an hour. So we'll post that on the Twitter feed and LinkedIn tomorrow. And I want to thank everybody for joining in. If you want to give us a call and ask questions, please do. If you got a question about your portfolio, reach out. If you are not a client, but you'd like to talk to us, we're always happy to have conversations. So thanks very much, everyone. And we'll talk to you again next week. See you, Pam.